Technical analysis is, of course, one of our key pillars, and we're going to spend some time looking at how professional traders approach this concept so that you will have a good grounding in it for your future learning. The first thing to say about technical analysis is that it's probably the simplest of all the pillars to understand and internalise. This is because it's extremely visual and the focus is on basic concepts that require virtually no insight or understanding, when compared to topics such as fundamentals, psychology and risk management. The purpose of this section is not to teach you how to use a chart or identify useful technical patterns, because all of this will be covered in great detail during the main training programme. The goal of this will be to help you understand its role in your trading plan, and also the top methods used by professionals, and mainly how many traders frequently misunderstand these technical concepts to their great peril. So let's begin by looking at what technical analysis actually is. When measuring technicals, analysts and traders are simply measuring the movement of the price from the past. Now, contrary to popular belief, when a professional does this, they're not trying to determine which way the price will go next, or in any way predict the market's next move. What they are in fact trying to do is identify good places at which to enter the market, or take their profits, or place their stop losses. This is because past price action can give some clues as to where the market might go in the future. Now, this might sound completely contradictory to what I've just said, but allow me to explain. There's a difference between predicting what the price will do next and identifying prices that the price is likely either to get to or not get to in the immediate future. When identifying a price to place your stop loss, for instance, you need to already know which way you expect the market to go, and you need to already have a reason for taking the trade. So let's use the example of a trade where you are buying euro US dollar. So you've done your fundamental analysis and you know what to expect. Expect this pair to go higher. Now also, you've got a very good reason for getting into this particular trade right now rather than tomorrow or the next session. It's this analysis that's given you your trade in the first place. Okay, the next step is to determine where to enter the market, and this is where technicals can offer some good value. In the same example, let's imagine that you can see that the price recently bounced up from a level of support. This bounce occurred fairly recently, and since then nothing has changed in terms of your expectation for the pair to rally. Now don't worry, we'll be explaining what a chart is in much more detail during the main programme, but for now it's enough to know that a chart is simply a way to visualise where the price has been in the past. You also notice by looking at the chart that the pair is currently sat at recent highs, making it prone to a sell-off based on something like traders wanting to book their profits rather than risk a breakout to fresh highs. Now, from looking at the chart, you now identified two key things. First of all, that it could be a higher risk to enter at the current price due to where it is in relation to previous trading. And secondly, a very good level to buy it back in the event of traders taking profits and forcing the price lower in the short term. From this simple analysis, you've avoided a situation where you bought at the highs and sustained some drawdown, and actually entered a situation where you waited for a pullback instead, entered at a price that you know the market has been buying from recently, thus vastly reducing your drawdown, helping your trading psychology, meaning smaller stops, which is one of the aims of the risk management policy, which we'll cover later, and ultimately giving yourself a much higher percentage chance of yielding a profit on your position. Now, bear in mind that none of that would ever have happened without the initial analysis identifying the trade in the first place. But also remember how much that little bit of technical analysis added to that trade and also assisted your performance overall in terms of all four pillars. This is how technical analysis is to be viewed and approached. And this is also why it's extremely valuable in unison with everything else, but totally useless on its own. So the mistake most traders make is not so much using technical analysis, but overusing it and trying to get it to perform the function of all four pillars rather than its actual role. Now, professional traders actually only focus on a few core concepts when it comes to technical analysis, and we'll go through each of those next. So the first concept is perhaps the most well known and traded one in the entire professional world, and that is the concept of support and resistance. A key facet of support and resistance is that it's primarily based on the concept of psychological trading levels, which means that traders very often look to buy or sell from certain prices because of some key psychological reason, which we'll look at more deeply now. Now, the first type of support and resistance level that traders use are prices that the market have previously been buying or selling from in the recent past. Traders identify these levels by looking at a price chart. A price chart is simply a means of tracking the movements of the price in a visual way so that you can see very quickly where the price has been and when. Japanese candlesticks form a major part of most traders' price charts by showing what the market did at each price. For example, at some prices there may have been a lot of selling occurring, or at another price the candlesticks may indicate that the price is running out of steam and may soon stop moving in the direction that it's been. When you have this visual of the price, you can then apply other tools to it in order to measure the price and get further insights from it. We'll cover in more detail shortly, but basically the principle is you get those extra insights and extra layers of analysis. So now you have the price charts and you identify an area that's already seen some buying or selling, you can mark that particular price, and if the market starts trading at the level again, potentially take a trade from there. Of course, this does not mean that you should necessarily trade from that price again, but it does give you a very good reference point when looking for entries and exits in the market. The reason that these levels are so psychologically powerful is purely the fact that there were such strong orders there in the recent past. So if the fundamentals or the sentiment of the market hasn't changed, you see the pair trading at a previously traded level, there's a very high probability that similar buying or selling will occur again. Very powerful levels are the highs or lows of previous sessions, the highs or lows of recent months or weeks, along with general levels that attracted serious buying or selling pressure in general. This type of activity is displayed by most charts, but candlesticks offer the most detailed analysis, which again will be covered in more detail during the main program. Of course, if the fundamentals or sentiment have changed, then that same level will be largely ignored by the market on the next occasion. Another psychological level has to do with the price itself. And what I mean by this is that very often certain numbers will get the market's attention and thus create like a powerful psychological level in the traders' minds. For example, imagine that the euro-US dollar currency pair is trading currently at 109.34. Now imagine it getting up to that 110 level. This 110 level is such a nice round number, and traders will naturally gravitate towards it as an easy to identify level. Most round numbers have this effect, so anything with zeros on the end will generally or usually generate at least some small reaction, especially in line with the prevailing fundamental trend. Numbers in between double zero levels also provide the same effect. For example, 109.50 is right in the middle of 109 and 110, so it will be naturally noticed by traders as a key level. These levels can also be used when placing your stop losses. Now imagine if you just sold the US dollar versus the Japanese yen currency pair from a key psychological level of 120, and you are now looking for a good price to place your stop. A price that would give the trade plenty of room to breathe, so to speak, but not result in a heavy loss if it got hit. By looking at the price and using the recent levels of support and resistance, you can see that the highest price the market traded the pair up to over the last few sessions. If you have a very good expectation of it dropping lower, and the fundamental analysis supports this, then it's pretty unlikely that the market is going to drive the price past those recent highs to make brand new highs. Therefore, if you are correct in your analysis, the stop loss will never get hit. But if you are wrong, then you've controlled your loss efficiently. This leads us well into the next concept, which is Japanese candlesticks, and this generally tends to form the basis of most traders' technical analysis. A candlestick is something that most of you may be familiar with if you've ever even had the slightest trading experience. For those of you that are not aware of them, you will of course receive a detailed training in what they are and how they work as you make your way through the main program. As an introduction, they come from 17th century Japan, which historically is known as a nation of warriors. Now this probably explains the use of military terminology with regard to the various candlestick charts and patterns. It's also worth noting that many of the same skills required in military combat are also required in trading, which is covered in more detail during the trading psychology section of this institutional fundamentals course. The concept of Japanese candlestick charting is credited to the legendary Manisha Homa, who is believed to have created vast wealth for himself trading rice futures in the 17th century. Having been given control of the family business in the middle of the century, Homer began trading at his local rice exchange in the port city of Sakata. Now, Sakata was the collections and distributions area for rice, and following the death of his father, Homer was given control of managing the family's financial assets, despite actually being the youngest son. Subsequently, Homer went on to Japan's largest rice exchange, the Dejima Rice Exchange in Osaka, and began his trading of rice futures. Now, the Homer family had a huge rice farming estate, and consequently had all the information about the rice market readily available to them. And in addition to this, Homer kept records of the yearly weather conditions. In order to learn about the psychology of investors, Homer researched rice prices for many decades and also set up his own communication system. At prearranged times, he placed men on the tops of roofs to send signals from Osaka to Sakata. After dominating the Osaka markets, Homer went on to trade at a regional exchange in Edo, which is now modern-day Tokyo, and he used this knowledge of the markets to amass a huge wealth. He is also said to have had 100 consecutive profitable trades. In later life, Homer became a consultant to the government and was given the title of samurai. He died in 1803, and his trading principles evolved into the candlestick method of the charting currently used in Japan and around the financial world. The success and name Homer built up with his methods, of course, ensures that traders today still implement his candlestick charting methods. Candlesticks are used mainly as a method of displaying how the price has behaved at certain levels. Did the price trade right through it? Did the price encounter strong resistance? And does the price look like it's becoming exhausted at those current levels? All of these things are only a very small part of our overall analysis, but in its place can provide some very useful insights. Now, the next concept we're going to look at is that of moving averages. This is another concept that gets frequently misunderstood by traders and thus massively misused. The purpose of moving average is to provide a visual price that is considered the average based on the price's recent behaviour. The idea is that the price should remain relatively close to this average over time. Again, the goal when professional traders use moving averages is not to try and predict the next move or where it will go next. Instead, the purpose is to simply gauge where the price is in relation to its average, and then use this information in combination with fundamental analysis to try and determine the nature of the recent price moves. Now, let's look at an example to explain this. So let's use the example of the price of the US dollar Swiss franc currency pair. Now, let's say that's in a long-term fundamental downtrend and it's been heading lower consistently for a few weeks. All of the fundamental analysis supports this trend to continue, and any pullbacks should be considered good opportunities to sell into that trend at a better price. Now, as we look for an opportunity to enter the market, we'll be keeping a close eye on the average price, because if the current price is much lower than the average, we know that this represents an unattractive opportunity. And over time, entering trades at these types of levels will increase our risk of drawdown and losses. If the price is above the average, the opposite becomes true, because we have excellent reasons to be looking to sell, and now the price is actually expensive in relation to its average. This could be considered a great signal to start looking for a place to enter the market in line with that fundamental trend. Now, one theme you'll notice as we go through this section is that it's never the indicator or even the chart that tells us what to trade, which way to trade, or even when to trade. This element is always the secondary analysis that is used to perfect the entry or exits and ultimately reduce our risk. You'll find that the news feeds will alert you when certain currency pairs have reached or breached their respective average prices. Most professionals use daily moving averages, and the most popular ones are the 50-day, the 100-day, and the 200-day moving averages. When used more intensively or on smaller time frames, they become far less effective. Remember, the overall principle of technicals is to use them in their place. Now, the next technical principle that many professional traders use is something called Fibonacci. Now, the concept of Fibonacci is actually very interesting and is based on the work by an Italian mathematician named Leonardo Fibonacci. Now, among a whole host of other work, he came up with a concept called the Fibonacci ratio. He discovered that a simple series of numbers actually create ratios, and these ratios basically describe the natural proportions of everything in the known universe. The sequence starts at 0 and then followed by 1, and you add those two numbers together to give you the next number, which of course is 1, and then you add together the most two recent numbers to give you the next number. So from 1 it goes to 2, and then it goes to 3, and then to 5, and then to 8, and so on. After the first few numbers in the sequence, if you measure the ratio of any number to the succeeding higher number, you get a ratio of 0.618. If you measure the ratios between alternate numbers, you get 0.382. These ratios are called the golden mean. The most interesting thing about this concept is how prevalent it is in almost every aspect of the universe. Everything from ancient buildings to the human genome have been observed to express the golden ratio in its structure and design. Because it's such a widely used concept, it has of course found its way into the world of trading as investors continue to look for an edge in the price behaviour of the markets. Fibonacci is another misunderstood and misused concept because traders imagine that the markets move somehow based on these ratios. In reality, it's the fact that so many traders watch these levels that they very often instigate a reaction from the price. So the way traders use Fibonacci ratios is quite simple. They wait for the price to move and then look for a retracement to one of the key ratio levels before getting in on the move in the expectation that all the other traders will be doing the same, thus pushing the price back in the original direction. This is called trading the retracement, and the tool used to measure those retracements, of course, is called the Fibonacci retracement tool. Now, traders will very often anticipate a move, but wait for the price to pull back to one of the key retracement levels first. Now, the most popular levels, of course, are the 38.2 level and the 61.8 level. But over time, other levels have been included that actually have nothing to do with the Fibonacci ratio. And these levels include 50%, because it basically represents exactly half of the original move, which many traders deem significant, and of course a 78.6% level too. As with all other technical concepts, this is to be used as a secondary measure in order to gauge an entry into the market that you already have a reason and direction to trade. Now, the topic of technical analysis can be a complete study course in itself, as is the case with each of the 4 pillars. But this has hopefully given you a good solid understanding of the main concepts. The overriding thing to remember about technicals is that they are only a secondary form of analysis, and it should just be the final layer to your trade plan that refines and simplifies your trade. In tandem with everything else, it can be an extremely powerful tool, but do not make the mistake of over-relying on it, because the more singularly you focus on technicals, the less effective it becomes. Your analysis should be around 80% fundamental and 20% technical to get the absolute best from your overall trade plan. So, take the information here as a starting point and certainly expand your knowledge via the main training and the workshops it will provide, along with your own personal research, but just remember not to get sucked into the trap of trading solely this form of analysis.